If you've been using Bollinger Bands the same way everyone else does, just waiting for price to hit the top band to sell and the bottom band to buy, you're probably getting faked out a lot. The truth is, Bollinger Bands are powerful, but only if you understand what they're really telling you about volatility and market behavior. Let's start with one of the most reliable techniques, the squeeze. When the bands contract and get really tight, that's the market telling you volatility is low and a big move is likely coming. Most beginners ignore this phase because it looks boring, but this is where smart traders pay attention. When price starts breaking out of that tight range with momentum and volume, that's often the beginning of a strong move. The key here is not to jump in blindly, but to wait for a solid candle close outside the band and ideally some confirmation from trend direction. Now here's where many traders go wrong. They think when price touches the upper band, it's automatically overbought. Not true. In a strong trend, price can ride the outer band for a long time. This leads to the second technique, the band walk. In a strong uptrend, you'll notice price repeatedly touching or staying near the upper band, while the middle band, which is the 20-period moving average, acts as dynamic support. Instead of fading the move, experienced traders look for pullbacks to the middle band to enter in the direction of the trend. The middle band is underrated. It's not just a random line. In trending markets, it often acts as a decision zone. If price pulls back to the middle band and holds, that's usually a continuation signal. If it breaks and closes strongly beyond it, momentum may be shifting. Another powerful setup is the Bollinger Band reversal with confluence. This works best in ranging markets. When price taps the upper band and you see rejection wicks, divergence on RSI, or resistance from a higher time frame, that's a much stronger short setup than just selling because it touched the band. Same thing on the lower band with support and bullish divergence. The bands alone are not a signal, they're a context tool. Risk management is where most traders fail with Bollinger Bands. Volatility expands quickly, and if you don't control your stop placement, you'll get taken out even if your idea is right. One approach is placing stops beyond recent structure rather than just outside the band. That gives the trade room to breathe. Now, if you're someone who likes structure and automation, this is where tools can help. For example, using a system that can scan for volatility contractions, detect trend strength, and manage trailing stops automatically makes a big difference. Something like the Trading Management Solutions EA can actually handle the execution side, especially when combining Bollinger Band strategies with automated trade management, break-even logic, and partial closes. It allows you to focus more on identifying quality setups instead of manually adjusting every trade. But whether you're trading manually or with a system, the real edge comes from understanding market conditions. Use Bollinger Bands differently in trends versus ranges. Watch for the squeeze before big moves. Respect the middle band, and always combine the bands with structure, momentum, or higher time frame confirmation. When you stop treating Bollinger Bands as a simple overbought and oversold indicator and start using them as a volatility and behavior tool, your trading decisions become much sharper. That's when the bands